So yeah, let's get into it then, Bob. All I wanted to do was sort of get a really brief and great understanding, in-depth understanding of like what's going on in the market right now, specifically with the economy, how that relates into the property market, and ultimately where the opportunity is for investors. That's what everyone wants to know. So from your perspective, could you just talk us through maybe the economics of what's happened and what's led to this kind of place that we find ourselves in right now?
Yeah, that's fine. Everyone knows that we had a base rate cut. We went down from 5.25% to 5%. That was
Expected or unexpected?
no, that was expected. Yeah, but a bit later than expected, in fact. So we expected a 0.25% cut in September, but it was a bit earlier than expected. In fact, the market was pricing in September cut, but it happened in August, which is good news. And that was the first cut in 52 weeks, 52 months. Sorry.
Okay.
Uh, but we've always seen an upward incline since then, and now thankfully it started to come down.
Mm.
Now the prospects for
Why has it started to come down? What was the decision? Like what was the mechanism behind the decision there?
it was only because due to inflation being controlled now at 2%.
Mm.
So because it's maintained at 2% for a couple of months now, coming down nicely from the highs of 11, 12. So they now feel that they can actually cut rates, but not too fast, because
Yeah.
we're not out the woods yet in terms of inflation. It's expected to rise again in a couple of months' time.
So basically what we're saying is that at the moment the economy is reasonably or much more under control than it used to be, and as a result we don't need to have the interest rate as high as it used to be. But like you said, we're not going to start reducing very quickly because we're not quite out of the woods just yet.
We're not quite out, but the bank's got one eye on the recession and one eye on the economy. They don't want the economy to slow down too much, which is exactly what's happening in the States.
Mm.
They don't want recession, so if they start cutting rates aggressively to stave off a recession, then UK, I think, will have to cut rates a little bit quicker than they wanted to, just
Mm.
to maintain the exchange rate parity.
So what you're saying is on one side, we've got kind of like fears of a recession if the rate's too high. On the other side, we've got fears of inflation running away if rates are too low. So we've got to kind of maintain rates at this level to make sure we don't go too high or too low.
Yeah, it's a fine balance, and that was seen out by the vote. It was 5-4 to cut, so it
Yeah.
wasn't totally unanimous. It was a 5-4 vote, which meant some members of the MPC Monetary Policy Committee were still a little bit hesitant to cut at this stage.
Yeah. Cool. And so the rates are being cut, and now what are we sort of expecting going forward?
We're expecting a further cut, probably I think September, October, maybe another 0.25%. That would really send the right signal to the property market and get those first-time buyers or investors waiting on the sidelines to come out the woodwork.
Okay, so
Is that
actually what you're saying, I was thinking maybe it'd be a bit, certainly by the end of the year, but a little bit later down the line. But you're saying, actually, I think it's going to be September, October time because we're kind of scared that we're going to fall into recession.
and because America might cut as well?
And why does America cutting affect us cutting?
Because of the exchange rate mechanism, because the UK and the pound to the dollar has to sort of keep its level, and if we're out of sync with America in terms of interest rates, money could flow there instead of here. So we have to keep the
Ah.
sterling dollar balance pretty much in check all the time.
Oh, okay. So basically what you're saying is that whilst we have our own economy, we do need to like make sure that we are maintaining in line with what America are doing to maintain that parity between the sterling and the
Yeah,
dollar.
yeah. Look what happened in Japan. Bank of Japan have actually raised their rates.
Mm.
Um, because they were running up, very, very low rates for the last 10, 20 years,
Yeah.
practically zero. So they're now also concerned, and that sent reverberations around the capital markets around the world when they did a 0.5%, 0.25% hike to
Okay.
0.5%. So yeah, everything is interrelated in the world.
So what happens then if rates do then drop again? So we've had one rate reduction and then there might be another rate reduction. What does that mean for people that are looking to invest?
It means any new mortgages will be a lot cheaper. And the difference between last year's rates back in August 23 and August 24 is now over 1%. So in
Mm.
terms, the rates have actually dropped 1%. And if that can be repeated again, and as you know, you can now get residential rates below 4%, 3.9 on a 5-year fixed rate with a 40% deposit. So if that comes down to 3%, that's a good signal for the market, and yeah, they're not going to go much lower than that. That's our forecast. Even 10-year money swap rates are 3.6 something.
So what you're
So
saying is that the rate from a year ago to now has come down by about 1%, which
yeah,
for,
roughly.
I mean, ultimately that's what, probably about 20-25% in terms of like the actual amount that it's come down, which is a decent amount. And what we're saying is that with the rates having come down already, there's a sort of signal, isn't there, to people, to investors. What's that signal telling the investors? What's that signal telling the market?
It's a trend, isn't it? It means it's maybe time to go back in, because it's hard to make money when buy-to-let rates are 6 and 7%, because
Yeah.
in the south, as you know, the yields aren't there, are they? So people have been travelling up north to Leeds and Manchester to buy their investment properties, because the yields up the north are 8 to 10%, whereas here
Mm,
4% on average.
mm,
So you're not making, if you're paying 4 or 5% on your buy to let, and you're going to pay tax on that income as well. Remember, because of the Section
mm,
20, you're not going to make much money on buy to lets in the south.
mm.
So when rates drop to 3%, then you have a chance of making some money.
Okay, so what
That,
you're saying is that when rates drop, the rental return increases, and as a result, more people want to get into the market, and so the demand for properties increases. And of course, if the demand for properties increases, then I guess the knock-on impact is that the price of properties will increase as well.
it's inevitable, isn't it? And
Is
right, reported year-on-year increases overall at 2%, which is not bad for a market that we were expecting to crash big time. Many forecasters saying, "Oh, we're going to lose 20%, 30% of the market value." That didn't happen, did it? Despite COVID, despite all the challenges we've had, despite the high interest rates, we're still there. We're still standing, aren't we, as a market?
Okay, so cool. So what we're saying is that effectively, because of these rate reductions, we know that property prices over the next 2, 3, 4, 5 years are going to increase.
In a,
And is that you say inevitably? Is that even inevitably, even with the Labour government in place? Let's talk more about the Labour government.
yeah, that's a big question mark, as we all know, because until their budget is announced on the was it 30th of October, we
But
don't know.
yeah,
There's lots of talk everywhere of increasing capital gains tax, hitting the corporates, because they can't increase personal rates, because that was their manifesto.
hedge. Yeah.
And obviously their pledge to build 1.5 million homes, that is unrealistic, as we all know. It's never happened before. But any price increases that would have normally happened may not be as big as maybe what we think, because of the new homes being built, and they're probably going to be earmarked not for investors, but for first time buyers only. That could be a big planning change they bring into play, to stop overseas investors piling into these big tower blocks and snapping them up, and not letting first time buyers have a bite of the cherry.
And that's interesting what you say, Bob, because obviously you've been in the market for quite some time now. So you've sort of probably seen other governments, successive governments come in and say, yeah, we're going to build 1.5 million houses or whatever it might be. And you're saying that actually that's really unrealistic. Why do you think that's unrealistic?
Because if you look at the reports that have been issued, we haven't got the labour force.
Yeah.
We haven't got the labour force to build that many homes. So unless we start importing labour again, which some quarters of the government won't be keen to do, because we're trying to control immigration on one hand, and
Yeah.
as we really can't see it happening.
I was talking to a developer friend of mine, and he said that his projects have stalled because there's a shortage of bricks right now. They just can't get the bricks, and the only way you can get bricks is by importing them from China, which is crazy, isn't it? So it's not just labor there's a shortage; it's like materials are a shortage as well. And I suppose what they, it's always funny to me that what they say in their kind of policy pledges to get people to vote, and then what they can actually deliver is so different. It's almost criminal, isn't it? It's like say what you want and to get in power, and then you can do what you want.
Do what you want afterwards. Yeah, absolutely. Yeah, then throw the manifesto in the bin, basically. Um, but no, every government does that. They've been doing that for centuries, so it's nothing new. Shouldn't be shocked by it. But the proof will be in the pudding over the next
In
6 years.
October.
If they don't hit the target in the 300,000 homes this year, then it becomes
Yeah,
more the year after, more the year after. So,
yeah.
you know, they're going to have to do some explaining when the next election comes.
Yeah. So actually, but one thing that's interesting, so we're in August right now, early August, and you're saying that at the end of October there's going to be this budget, and that budget's going to tell us a lot more about what they're actually doing. And let's
Yeah,
just assume that that budget tells us what we already know, like what they've already promised to do. Then what we know is that property prices are going to increase, and of course, because it's a Labour government, they're going to redistribute the income to effectively tenants. So as a result of that, rents will also increase. So property prices are going to increase, rents are going to increase. That's what we think is going to happen. Um, if they say that on the 30th of October, at the end of October, then we effectively have this window between now and the end of October to kind of get involved before everyone else piles into the market. Is that right?
yeah. You need to take a step back and look at your portfolio. Um,
Mm,
Bet your bottom dollar capital gains will be increased in line with income tax.
mm.
So it will go up to 20 or 40%. So if you're looking to offload anything sensibly, I think do it now before the budget.
Yeah.
So lower taxation. Otherwise, it could be a different story.
Yeah, yeah. It could be a different story, but what I'm saying is, so that's on the capital gain side. But ultimately, if we know that rents are going to increase and property prices are going to increase, as soon as people can confirm that, as in on the 1st of November, then people will go, hey, rents, the interest rates are coming down. We know that rents are going to increase. We know that property prices are going to increase. We have been looking to invest for the last 2 years, but we haven't been able to because the mortgage rates were at 7%. So now is a good time to get in because otherwise we're just going to have to wait another 2 or 3 years until the rates come down even further. So there's no point in waiting any further. We might as well get in. And I think there's this kind of like pent up demand from, the days before Liz Truss or just when Liz Truss came in place. Because at that time when rates shot up from 3% to 7%, everyone sat on their hands, isn't it? And they said, well, we don't want to invest right this second because we don't know what's going to happen. And then since then, rates have been reasonably steady, coming down a little bit, coming down a little bit, and they're coming down to about 5.5%, I think. But ultimately, as soon as the base rate starts to come down, which it has now, that sends a signal to the market that the mortgage interest rates are going to come down over the next year or so. And if they do, then we know that property prices are going to increase. So that's why I think there's going to be a lot of people who effectively post that budget are going to say, shall we just get on with it? And so the increase in demand for properties, that means even more increase in price of properties. And I think that therefore there's this like window of opportunity right now before that happens to get
I think
involved, buy the properties, and also buy the properties at a cheaper price because you can negotiate better on the prices. There's less people in the market, but there's even less people right now because we're in August, September. Like this is summertime, and summer. Guess where everyone is on cruises, on holidays, and all that kind of. And even if they're not, they're in their garden drinking beer. They're not out looking for properties. That's what I think. Is that kind of what you're thinking?
I've been telling my viewers on my sort of TikTok channels that get into the market now because this market has bottomed out, and the only way now is really up again. So
Mm,
I'm echoing what you're thinking. I think the market does have a lot of pent up demand. A lot of people have been waiting on the sidelines for far too long, really, and I think now is a good time to enter the market. Whilst it's still a buyer's market at the moment, you can
mm.
negotiate prices for quick sales and things like that. But when the shoe's on the other foot and it's a seller's market, you may not be able to negotiate as hard at that time. So I think now is a
Which it
good.
was, just 2 years ago. 2 years ago it was a seller's market, and whatever price the agent put it on for, you'd have to pay £5,000 or £10,000, easily more than that, just to get the property. Now we're saying you can pay £5,000 or £10,000 less. So do you want to save £5,000 or £10,000, or do you want to pay £5,000 or £10,000 more? That's what the question is, isn't it?
Basically, yeah, yeah. But stop planning now. Stop planning your mortgages now. Stop planning your
Yeah,
investments. Do your research as to where you want to buy. And obviously, Leeds pretty well. That's a good area, long term, and has been for many, many years. So I
yeah.
think yes, stop planning now. I think you've got to really act in the next month or so.
And actually, one of the things that people think is, oh well, we'll wait until the rate reduces because that's when the mortgage rate reduction will happen. But what I've seen is that the mortgage companies anticipate rate reduction and start to reduce their rates kind of before the base rate reduces. Is that kind of what you're seeing as well?
Well before, because they go by the swap rates. They don't always go by the
Yeah.
uh, Bank of England base rate as such. If the money markets are pricing the rates down, they'll buy at a margin above swap rates and then lend it on again. So banks don't really care what base rate is really.
Okay. Yeah.
Swap rates they go by, not the Bank of England base rate.
And of course, like let's say for example, if we agree a sale today, it's still going to take us 3 or 4 months to actually buy that property and complete on the property. So if in that time period the mortgage rate goes down, I presume that the lender, you could go back to the lender and say, I want today's rate. I don't want the rate that I agreed 3 months ago. Is that right?
You do, yeah. Lenders won't notify you if they cut their
Yeah.
rates. If you're dealing directly with them,
Yeah.
uh, that incentive to look after their client as much as what brokers do. But we have software that allows us, that alerts us when a rate does drop. And if the client hasn't completed by then, we then always do it automatically for the client anyway.
So from a broker's perspective, it's kind of like a no-brainer because you agree the sale today, and if the rate goes down, then you're gonna notify the client and agree the lower rate anyway. So they're going to benefit anyway.
Yeah, the client benefits, yeah. But the banks, if you go direct to banks, you don't get that
They
service.
don't do that. Yeah, absolutely. And the final thing I just wanted to touch on as well, Bob, was that, so we've talked about the economics of what's going on and what has happened, what is going on right now, and what we think is going to happen over the next year or so. But in property, we're not talking really about like the next year. We're talking about, property is a long-term game. This is 10 years, 20 years down the line. So in some ways, like what's happening right now, it almost doesn't matter what's happening right now because actually what we're looking for is the next 10 or 20 years. And people say, oh, well, I shouldn't invest right now because we've got Labour government. Well, over the next 20 years, we're going to have lots of different governments, maybe Labour, maybe Conservative, maybe who knows what. But the point is, you can't stop your investment plans just because, there's a policy that's different right now. Is that what you're thinking as well?
Um, yeah. This is no longer an amateur's game. Yeah, this is now professional landlords. There's a lot of legislation that you have to be careful of, and you
Mm.
can't think short term anymore in the buy-to-let market. So
Mm.
it's 10, 15 years, maybe longer. I mean, I've had my buy-to-lets for 25 years now. So
Mm.
that's pretty well. They've gone up nearly 8, 9 times in value over that time. So
Mm.
happen again, but certainly with time, with inflation, prices will go up.
Yeah. So what you're basically saying there is that because of the way that the government is moving, the direction of the whole kind of private renter sector, we need to be much more professional in our approach to buy-to-let properties. And obviously that involves using professionals like professional independent mortgage brokers, professional solicitors, professional management agencies, professionals that can go and find the right properties for you, that kind of thing. Is that what you're saying?
Treat it like a business, not a hobby.
Fantastic. Perfect. That sounds really, really good. And I think on that note, that's exactly the takeaway from this. We've got to treat it like a business, just like you would do with any business. You want to have the experts that are doing these things for you, not kind of trying to just run around doing it yourself. When your boiler is broken, you don't just have a go at it, do you? You just call the plumber because he's the expert. He knows how to fix the boiler.
Yeah.
Fantastic. Bob, that's fantastic. Final sort of words from you of wisdom or any, if you had like one top tip for investors right now, what would it be?
Review your portfolio. Make sure you're always paying the lowest rate on your portfolios. Liaise with a broker that's going to look after you for the next 5, 10 years, not just on this transaction, and
Mm.
then long-term relationship that way, because we've got systems behind us in our office that can look after your portfolio for you. We'll monitor it,
Mm.
so you haven't got to worry about not ever paying the best rate on the market because we'll let you know what the best rates are.
And
So I
if
think
people don't have portfolios right now, is there some way that, because what I was also looking at was the way that people could right now potentially use their the equity that they've got in their residential property, somehow release that money and then go and invest in properties. Is that kind of the way if you don't already have a portfolio?
yeah, people do that all the time. Yeah, so if there's scope to release more money from the prime residence from the main house, use that to act as a deposit for the next buy to let. But again, advice is required around that because you can buy to lets in your personal name, you can
Mm.
buy to lets as a partnership, you can buy to lets as a company. So which way do you go? So we always encourage you to take tax advice as well. So it's not purely
Yeah.
investment, it's not purely about the mortgage, it's about the package. What's
Yeah.
most what's most tax efficient?
Yeah, absolutely. And that's exactly what we can do at Lifestyle Property People. We can sort of package the whole thing up for you with all the partners. So it's a one-stop shop to do everything
Yeah,
for you. Perfect. Bob, thanks so much for your insights. It's always great to get the experience that you have behind it, backing it. And I think one of the important things about talking to someone like you rather than someone who's new in the market is that you've seen this happen for God knows, 20, 25 years probably. And so you've
yeah.
seen that when governments promise things, like what actually happens, what actually comes out of it. So if you're saying that property prices and rents are going to increase over the next 3 or 4 or 5 years, and now's the time to get in, then that's probably going to be the right way to look at it. So no, I appreciate your honesty and I appreciate your insights on that.
Thank you very much, Shiv.
Thanks for your time, Bob. Cheers.